Hi everyone, today I'm going to be explaining the basics of the Canadian tax system. This has been one of the most requested topics recently. I'm going to keep this video basic just for beginners, and I might focus on more advanced topics later on if there's an appetite for it. I try to keep my videos between 10 to 15 minutes, so I might cut this into two parts. There's just too much to say, too much to explain. It's almost overwhelming. I'm worried about giving a little information overload. It's very numbers heavy, there's just too much to say. If there's enough interest, I might do a rant style video where I talk about how the Canadian tax system is designed so the rich get richer. I could go on. Okay, back on topic. I have a lot of experience with Canadian taxes. I started learning it in university to get my accounting degree, and then preparing tax returns as part of my CA designation. But most of my research in the past 10 years has been to benefit myself. Sometimes you don't know what expenses or deductions are available to you, and then the rules change every year. I'll leave links to all the images and websites I'm using for reference if you want to go back to it after the video. I'll start off with a little intro to Canadian taxes, then talk about non-taxable items. I'll break down the tax brackets. I'll talk about the different types of income, and lastly, I'll talk about refundable and non-refundable credits. Starting off with a little intro to the Canadian tax system. Canadians are taxed on their worldwide income. A lot of people get caught in this. If you live in Canada but you do online services for companies or individuals across the world, you have to declare that income even though, it's in a tax-free country. If you do a 9-month secondment, let's say in a tax-free country, you live there, don't pay any taxes, come back, you're still a resident of Canada, you still have to declare that income as Canadian income even though you earned it in another country. There are no free rides. If you have no income, you don't have to file a tax return, but you could be missing out on refunds that the government owes you. So when you're 18, once you turn 18, just as a general rule, file your taxes every year. You might be missing out on refunds that the government owes you, that the government's offering to every Canadian. If you had income in the year and you didn't file your return, there are no penalties if the government owes you a refund. But why wouldn't you file your return if the government owes you money? That's your money, you should file your return, get that refund. If you did have income and you actually end up owing taxes at the end of the year, make sure to file your return. There are penalties there. The interest is high, so file and pay your taxes on time. The Canadian tax system is a progressive tax system. That means the tax rate increases as your income increases. Taxes are broken down into two parts. Well, 5 parts. Federal and provincial are the main parts, and then there's CPP, EI, and health premium. Provincial taxes change depending on where you live. Federal taxes are applicable to every Canadian. With provincial taxes, they obviously, your income can vary, your after-tax income can vary heavily depending on where you live. I believe Nunavut is the lowest average tax, with Quebec being the highest. Certain items aren't taxed. In Canada, gifts are tax-free. This is in comparison to the US, where if you get a $1 million gift from a friend, you have to declare that, you have to pay tax on that gift, which is weird. In Canada, if you get a $1 million cash gift, that is yours, no tax. Inheritances are not taxed. Imagine receiving your parents' inheritance, which is their stock portfolio, but then you get taxed on it, so you have to sell the inheritance to pay the tax on the inheritance you got, which is backwards. Thankfully in Canada, no inheritance tax. This is not to be confused with the tax that your parents' or grandparents' estate might pay. Let's say they have $1 million in stocks. There's a deemed disposition upon death, so you have to file a final tax return, which sounds like very eerie and ominous. So they have to pay tax on any gains that they had in their portfolio or their assets. Then everything after tax will come to you, and you do not pay tax on anything you received. Lottery winnings, gambling winnings, and game show winnings are not taxed in Canada. In the US, these are taxed. In Canada, it's all yours. If you win a $70 million jackpot, that's all yours. Insurance settlements and legal damages are not taxable unless the payout you received was to replace income. So let's say you're suing an employer for 2 years of missed out employment income. That means the government missed out on 2 years of your employment taxes. So if you get a settlement to replace 2 years of income, you do have to pay tax on that. But anything extra, if it was punitive, then that will not be taxable. That is tax-free. Lastly, income from selling a principal residence, a house that you own and live in, is not taxable. When you sell it at a gain, that is tax-free. But also, if you sell it at a loss, You also don't get a capital loss to apply against other income. Looking into tax brackets, this graphic pretty clearly breaks down the federal portion of income taxes. These are progressive rates. Everyone will be charged 15% federally on the first $49,020 of income in 2021. Obviously, these change every year. Then read the bolded part. The tax rate on the next $49,020, you'll be taxed 20.5%. So it's not suddenly 20% on the first 49 and now on the second 49. It's 15% on the first and then 20.5% on the second 49,000. Then 26% from 98,000 to 151,978, weird numbers, then 29%, then 33%. I'll run a few scenarios. If you earned $45,000 in 2021, you'll owe $6,750 in taxes. If you made $90,000, you'll owe $15,753.90. If you made $150,000, you'll owe $30,911. Keep in mind, these are only the federal amounts. You also have to add the provincial taxes. Every province has its own tax rate and tax bracket. Look at these 5 provinces, they're all vastly different. Assuming you made $100,000 in 2020, look at the difference in tax owing. This is the combined federal and provincial. You can pay as much as $29,200 in Quebec, $23,709 in Ontario, or $22,590 in BC. The most important part is your marginal tax rate, the new bracket you're in. Every additional dollar you get will be taxed at your current bracket until you get bumped into a higher bracket. If you get a raise, you shouldn't be afraid of getting bumped into a higher tax bracket. You'll never make less money by getting a raise, but you will pay more tax. Remember, the tax rates are progressive. Using this Wealthsimple calculator, take a look at the marginal tax rate. As I move the income level from $100,000 to $150,000, the marginal rate is the same. Obviously, the average rate is going up, but every additional dollar from $100,000 to $150,000 is taxed at 43.41%, which sucks. But take a look when I go to $152,000 in salary. The new marginal tax rate is 47%. You've been bumped into a new tax bracket. Every additional dollar will now get taxed at this new tax rate. Okay, so we've talked about the tax brackets, but then take a look at, if we're looking at that Wealthsimple graphic I showed, there are additional amounts that you'll pay. Canadians also have to pay EI, which is employment insurance, unless you're self-employed, which you don't pay. And then there's CPP, Canada Pension Plan, in every province except Quebec, where they have QPP. EI is paid by the employee and the employer. The amount varies. In 2021, the rate is 1.58%, up to a maximum payable of $889.54. If you earn $56,300 in 2021, you'll have paid the maximum amount of $889. If you have 2 jobs and you're charged double EI, you'll get the excess as a refund. When you file your return, you'll get the extra EI back as a refund. CPP or QPP are the pension plans. They're paid by the employee and matched by the employer. If you're self-employed, you actually have to pay double. You have to pay the employee and the employer portion. This is similar to EI, where it has a maximum amount per year. You cannot pay more than the maximum amount. You'll get any excess back as a refund. The rate is 5.45%, up to a maximum payable of $3,166, and this is adjusted every year for inflation. If you earn $58,100 in 2021, you'll pay the maximum amount. If you earn less, obviously you'll pay less. If you earn more, you'll only pay the max of $3,166. I'm going to go a little deeper on the CPP EI. There's some nuance to it. Since you pay a percentage every month until you hit a max, you might notice more cash going into your account after maxing out these 2. Take a look at the 2020 budget I made. When you make $50,000 a year, you pay CPP and EI every month. Look what happens when I increase the salary to $75,000. By September, you would have maxed out your CPP and EI. Then your monthly cash received increases. You were making $43.45 after tax. Then, since you maxed out your CPP EI, you take home $47.72. You maxed out your CPP EI by September, and the last 3 months you get a little extra cash. If I change the salary to 100,000, you max out CPP-EI by July. So your take home, your after-tax cash amount goes from 5638 to 6207. So you're getting a little extra cash in your account. Lastly, many people don't even know this exists, but there's a health premium. Some provinces have it, some don't. I know British Columbia doesn't have it. It's just another one of the government's hand in your pocket. If you're in Ontario, if you make under 20,000, you pay no premium. Then the rate increases to 300, 600, 900 if you make over 200,000. In Quebec, I believe the maximum payable amount is $642 in health premium. Now the confusing part, even more confusing than what I just said, different types of income are taxed differently. If you earn employment income or interest, unfortunately those are taxed the highest. There are no deductions or tax breaks for the average employee. If you're self-employed, there are a whole slew of deductions and tax breaks for you to reduce your tax payable. Self-employment income is very different. Self-employed Canadians don't have to pay EI, so they save 1.58%, but they have to pay the employee and employer portion of the CPP, so you're paying around 10% per year. This sounds like the self-employed Canadians are worse off, but since they have so many deductions available to them, self-employed income will always have more after-tax cash at the end of the year due to all the deductions. Anything you spend to earn income is deductible. This is not available to employees. If an employee drives to their office every day, that commute, their gas, their car insurance, and their car payments are not deductible. But if you're self-employed, driving to your clients' offices, you can deduct a portion of your car expenses to reduce your income. You can even deduct a portion of your phone, home office if you have one, and even meals and entertainment as you take out your clients. These are not available to the average employee. Earning $100,000 as an employee, it sounds great, but after tax, you're taking home around $73,000. If you had $100,000 of self-employed income, you might take home $85,000 after tax. The benefits are huge. Capital gains. These are probably the best form of income in my mind. They're the second lowest taxed when it's under $50,000 of income, and it's the lowest tax when you make more than $50,000 in income. Capital gains, pretty much buying an asset and selling it for a profit. If you buy stocks, sell it at a higher price, you're considered to have a capital gain. Now the wording is important here. Capital gains are 50% tax-free, 50% taxable. Keep in mind, I'm not saying you get taxed at 50%. That's where a lot of confusion comes in. If you make $10,000 in capital gains, $5,000 goes directly in your pocket. The government doesn't care about it. That remaining $5,000, the other 50%, gets added to your income and gets taxed at your marginal rate. So if you can, the majority of your income, if possible, should be capital gains. One item to note here are capital losses. If you have an asset, let's say you have shares, you sold them at a loss, a lot of people think they can offset that loss with their other income. But capital losses can only be applied against capital gains. People were gaming the system in the past to reduce their income. They'd buy a painting worth, let's say, $1 million, and then they sell it to a friend for $100. All of a sudden, they have like a $999,000 capital loss. They want to reduce their income. That doesn't work anymore. Capital losses can only be used to offset capital gains. Looking at this chart, if we're looking at Ontario, the capital gains are exactly half of the other income section. Capital gains are the best form of income. Lastly, let's talk about dividends, which can get very confusing. There are eligible and ineligible dividends, which are taxed differently. I'll focus on the most common, which are eligible dividends. These are taxed very favorably. To keep this explanation short and simple, dividends are paid out by companies. Companies have already paid tax on their income. So if they pay tax and then pay you, you're getting taxed, so there's a double tax scenario. In order to avoid this double tax, when you receive a dividend, you'll also get a tax credit to reduce your tax payable. This is about as simple as I can put it. If I go back to this Wealth Simple calculator, take a look at how favorable dividends are. The magic number is 50,000. If we only earn 50,000 in Ontario, we pay zero federal and provincial tax. We pay no CPP, no EI. The only tax we pay is a health premium of $600. These are the dividend tax credits reducing your income. If you're in Quebec, you pay a little more. With $50,000 in dividends, you'll pay $1,170 in taxes, which is still amazing if you think about it. BC got rid of their health premium, so with $50,000 in dividends, you pay zero tax. That entire amount is yours. Lastly, let's talk about tax credits. There are two types, which are refundable tax credits and non-refundable tax credits. Tax credits reduce your tax payable. So a refundable tax credit not only brings down your tax payable, but it can go below zero, which means you get a refund. The government will give you some cash back for these refundable tax credits, but they're not that common. Non-refundable tax credits can only bring your tax payable to zero. You will not be able to get a refund from these. A more common example are donations. If you make a donation in 2021, you get a donation slip. You can use this donation to reduce your taxes to zero, but you can't donate so much so that you reduce your taxes to zero and then get a refund on top of it. I think I'm gonna end it there for now. I'm not gonna be talking about RSP or TFSA because I've covered it in 3 or 4 videos in the past. I'm always worried about information overload, talking too much, and people getting turned off by the amount of jargon and numbers and rates in the video and then turning it off. So leaving it here for now. If there's appetite for it, I really want to do a rant style video, just like no images, no really research. It's just based on my experience of how the Canadian tax system is designed to make the rich richer. Please let me know if you have any questions or if I was unclear on any tax items. I'm going to be leaving links to any Canadian tax sources you need. A lot of people ask, do I have to pay taxes this year? I'll leave a link that can answer majority of your questions from the CRA or Canada.ca website. If you want to calculate your taxes, I would recommend using the Wealth Simple one. It's the easiest and most straightforward to use. And I know a lot of you are going to be asking this question, and I'll answer it now. No, I will not be doing your taxes. Sorry to disappoint.